Hi, welcome to my channel, Second PUC Accountancy, Learn, Understand and Excel. In the previous video, we had seen the formats of retirement, and today we are going to see a 12 marker under retirement of a partner. So this is the question given here. Under retirement of a partner, Pradeep, Sudeep and Sundar were in partnership, sharing profits and losses in the ratio of 3:2:1. And given here is the balance sheet as at 31st March 2025. Now we'll see where the items will appear from the balance sheet. Now on the liabilities side, first we have trade creditors. It will be transferred to the new balance sheet. Bills payable will go to the new balance sheet. Outstanding expenses will go to the new balance sheet. General reserve will go to the partner's capital account, and the capitals are the opening balance of all the partners, which will be transferred to the partner's capital account on the credit side. Now on the assets, we have cash at bank, debtors, stock, factory premises, machinery and loose tools. All these assets will be transferred to the new balance sheet. All these assets will be transferred to the new balance sheet. And following are the adjustments given here. On 1st April 2025, Sudeep retires from the firm, and the terms and conditions are given here. The first one, the goodwill of the firm is to be valued at rupees 6,000 and it should be treated as per AS 26. Next, we have outstanding expenses to be brought down to rupees 3,750. Next, we have is machinery and loose tools that are to be valued at 10% less than their book value. Next, we have is the factory premises that are to be revalued at 25,550. So now we have to prepare the revaluation account, partner's capital account and the balance sheet of the firm after retirement of Sudeep. Now let us see the adjustments and take the information what is given in the question. So first we have is the ratios. They have given in the question old ratio 3:2:1. And next, this can be written as Pradeep 3/6, Sudeep 2/6 and Sundar 1/6. Next we have is the goodwill treatment. Now here the goodwill of the firm is given as rupees 6,000. That is the total goodwill of the firm. Now since Sudeep is retiring, we have to find out Sudeep's share, that is 2/6. So therefore Sudeep's share of goodwill will be 6,000 into 2/6, that will be 2,000. In the previous video, we had already seen how to treat the goodwill under retirement as per AS 26. So here, Sudeep's share of goodwill, rupees 2,000, is shared by Pradeep and Sundar in the gain ratio. So since there is no information given to us about the gain ratio, the old ratio itself will be the gain ratio. The gain ratio of the existing partners will be 3:1. So Sudeep's share of goodwill will be borne by Pradeep, which will be 2,000 into 3/4, that will be 1,500. And Sudeep's share of goodwill, which will be borne by Sundar, will be 2,000 into 1/4, that will be rupees 500. Now we are going to post this in the journal entry. Now what is the journal entry to treat the goodwill as per AS 26? So here the retiring partner's goodwill will be shared by the continuing partners. So the journal entry will be Pradeep's capital account debit 1,500 and Sundar's capital account debit 500 to Sudeep's capital account 2,000. Being Sudeep's share of goodwill adjusted to existing partners' capital account in gaining ratio. So this is with regard to the goodwill treatment. Now we are going to see the other adjustments, how it has to be treated. Now, the other adjustment which is given here is the outstanding expenses. The outstanding expenses are to be brought down to rupees 3,750, which means it is the decrease in the liability. So therefore here this decrease in the liability will be appearing on the credit side of the partner's capital account, and in the balance sheet we will record only the new liability, that is 3,750 in the balance sheet. So in the revaluation account, we have to record on the credit side the amount of decrease of the liability, that is 5,000 minus 3,750 is equal to 1,250, which will be on the credit side of revaluation account. And in the balance sheet, we will record 3,750, which is given in the adjustment. That is the decreased value of outstanding expenses. The next adjustment we have is the machinery. The machinery is being valued at 10% less, that is, it has to be reduced. So, as the machinery value has to be 10% reduced, the value will be 8,000 into 10 by 100, which will be 800 rupees depreciation. So, which will appear on the revaluation account debit side 800, and in the balance sheet it will appear on the asset side, which that 800 rupees should be deducted from the machinery on the asset side. Now, in the same adjustment, we have also another adjustment which states that loose tools are to be reduced at 10%. So, this is also again a depreciation of loose tools. So, the value of depreciation will be 5,000 into 10 by 100, which will be 500 rupees. And this is the depreciation or decrease in the value of loose tools. So, therefore, it will appear on the revaluation account debit side 500, and in the balance sheet on the asset side we will deduct it from the loose tools. Now moving on to the next adjustment which was given here as per the question, we have is the factory premises. The factory premises are revalued at rupees 25,550. When a revalued amount is given in the adjustment, we treat it as the new value of the asset, new value of the asset, which should appear in the new balance sheet. So here we have to compare and find out what is the increase or decrease of factory premises. The book value is to 22,500 minus the revalued amount 25,550. The difference, it says that the value of the factory premises have been increased. So there is an increase in the asset of rupees 3,050. So it is increase of an asset. So it will appear on the credit side of revaluation account 3,050, and in the balance sheet we have to add it to the premises, or we can write the revalued amount, that is 25,550 in the asset side of the balance sheet. So this is with regard to the adjustments and its treatment. So now let us prepare the revaluation account with the given adjustments. So the first adjustment we have here is the outstanding expenses, that is to be brought down to 3,750. So we had already calculated and we had taken the difference amount. So this is a decrease in the liabilities. So it will appear on the credit side of the revaluation account as outstanding expenses. The calculation will be 5,000 minus 3,750. So the decrease in the outstanding expenses will be 1,250. Now the next adjustment what we have is the machinery, that is to be depreciated. So we have to value the machinery at 10% less than the book value. So this is the depreciation in the machinery, which will appear on the debit side of the revaluation account as 2 machinery, that is rupees 8,000 into 10 by 100, which will be 800 on the debit side. And in the same adjustment, we also have loose tools that has to be valued at 10% less than the book value. So again, this will be the depreciation. So here, the depreciation of loose tools will appear on the debit side of the revaluation account as two loose tools. Again, this will be rupees 5,000 into 10 by 100, which will be 500 on the debit side. And if we see in the adjustment here, now the last adjustment, that is factory premises that are to be revalued. So we had compared the old value and the new value given in the adjustment, and we got an increase in the assets, that is the factory premises. So which will be increase in assets on the credit side of revaluation account. So we write it on the credit side of revaluation as by factory premises. So the factory premises will be increase in the factory premises. So which will be 25,550 minus 22,500, that is 3,050 is the increase of factory premises. So we have recorded the increase of the factory premises. So now we are going to balance it. So when we find the total roughly, the debit side is 1,300 and credit side is 4,300. So the highest total is 4,300, which should be written on both the sides. So here the credit side is more, so therefore it is a revaluation profit. We get profit 4,300 minus the debit side total, that is 1,300, which will be 3,000 rupees profit. We will be writing it on the debit side of the revaluation account as to revaluation profit transferred to partner's capital account 3,000. So Pradeep will get 3,000 into 3 by 6, 1,500 as his share of profit. Sudeep will get 3,000 into 2 by 6, that will be 1,000, his share of profit, and Sundar will get 3,000 into 1 by 6 will be 500. So now let us prepare the partner's capital account. Now this is the partner's capital account where we have on the debit side Pradeep, Sudeep, Sundar, and on the credit side Pradeep, Sudeep and Sundar. So first we need to bring down the opening balance, that is the capital which is given in the balance sheet for all the partners. So here, so this is the balance brought down from the balance sheet. Pradeep 20,000, Sudeep 15,000 and Sundar rupees 10,000. Now once the balance is brought down, next in the balance sheet we have general reserve, and this is also the reserve made by all the partners including the retiring partner. So it should be distributed to all the partners. So we will bring down on the credit side as by general reserve, that is rupees 12,000, which should be distributed to all the partners in the old profit sharing ratio, that is 3:2:1. So 6,000 will be for Pradeep, Sudeep 4,000 and Sundar rupees 2,000. Now next we have is the revaluation profit. So the partners have derived at the revaluation profit. Again, this profit should be distributed to all the partners including the retiring partner. So profit will appear on the credit side of the partner's capital account by revaluation account. Profit 1,500 for Pradeep, 1,000 for Sudeep and 500 for Sundar. Now next we have to make the goodwill treatment. We had already calculated Sudeep's share of goodwill, that will be adjusted by Pradeep and Sundar. So here that is the goodwill that is borne by the old partner Pradeep. It will be written as by Pradeep's capital account, and it is the share of goodwill which he is adjusting, that is Sudeep's share of goodwill, that is 1,500 under Sudeep's column. And also Sundar is also adjusting the capital for the retiring partner. So it will be written as by Sundar's capital account, that is the retiring partner's share of goodwill, rupees 500 under Sudeep's column. And since it is adjusted by the old partners, so we will also record it on the debit side as to Sudeep's capital account, that is the goodwill which is borne by the old partners, Pradeep 1500 and Sundar rupees 500. So this is the goodwill treatment as per AS 26 on the retirement of a partner. Now we need to find the balance of all the three partners, and it has been, all the entries are being made. Now first and foremost we have to balance the retiring partner's capital account and see what is the settlement that is to be made for the retiring partner. So the total of the retiring partners column, that is Sudeep's capital account, will be 22,000. So that's the highest total. So we'll write it on the both the sides of the partner's capital account. So 22,000 is the amount of total on the capital account of the retiring partner. So here Sudeep's account, we assume that his account is being taken as a loan account. It is not paid immediately. So we assume that it is taken as a loan account. So we are going to balance the retiring partner Sudeep's account, that is as to Sudeep's loan account, that is the balancing amount of Sudeep that is taken as a liability in the balance sheet. As we have not settled his account on his retirement, it is assumed as a loan account. Now once we have settled or we have balanced the retiring partner's account, now we have to balance the remaining partner's account. So the total of the remaining partner, Pradeep's total of the capital account will be 27,500. That's the credit side total, which is higher. So write the same total on both the sides, 27,500. So the balance of the continuing partners should be written as to balance carried down, which will be the new capital of the partners. So now Sundar's total of the capital account will be 12,500. So for his account also the credit side is higher, 12,500. So the balancing figure of the continuing partners will be the new capital of the continuing partners, which will be written as to balance carried down, that is the new capital. We will transfer it to the new balance sheet. So 26,000, that is 27,500 minus 1,500. 26,000 is the new capital of Pradeep, and for Sundar it is 12,500 minus 500. 12,000 is the new capital for Sundar. So this is the partner's capital account. So always remember, under retirement, first balance the retiring partner's capital account. If it is not paid immediately, transfer the balance to the loan account. Transfer the balance to the loan account. And if it is being paid immediately, transfer it to the cash or bank account. Now the remaining partners will be written as balance carried down, which will be the new capital. So now let us prepare the balance sheet as on 1st April 2025. That is the next day of the retirement of a partner. So we are going to break down all the assets and the liabilities of the old balance sheet to the new balance sheet along with the adjustments. So here on the asset side, we have cash at bank. So that will be entered on the asset side. Cash at bank 12,500. There is no change. Next, we have debtors and there's no adjustment. So we bring down debtors 15,000 as it is on the asset side. Next, we have is the stock. Stock also, there is no adjustment. So write it as it is, stock 12,000. Now moving on to the next asset, that is factory premises. For factory premises, there is an adjustment. It says there is an appreciation of factory premises. So we will record the adjustment here on the balance sheet asset side. Factory premises is 12,000 and the appreciation 3,050. So the total amount of factory premises is 25,550. The next asset what we have is the machinery account. Again, for machinery there is a depreciation, so we are going to record it in the balance sheet. So machinery account, is rupees 8,000 less depreciation 800, that is 1,200 for the partners. That is 7,200, which is the depreciated value of machinery. Now next asset we have is the loose tools. Now with regard to loose tools also there is a depreciation, so we are going to adjust the depreciation here. Loose tools is rupees 5,000 less depreciation 500, so the depreciated value of loose tools is 4,500. So these are the assets which are being brought down from the old balance sheet to the new balance sheet along with the adjustments. Now next, moving on to the liability side. Now liability side, in the old balance sheet we have trade creditors. So there is no adjustment for trade creditors. We record trade creditors 10,000 on the liability side. Next, on the old balance sheet, we have bills payable. So bills payable also there is no adjustment. So we are going to just bring it to the new balance sheet as it is. Bills payable 3,000. Now, next liability what we have is the outstanding expenses. Now, for outstanding expenses, we had an adjustment which says that the outstanding expenses are being reduced. It is being brought down. So we are going to take the new value which is given in the adjustment, that is outstanding expenses 3,750. So we will not consider the old balance of the outstanding expenses as it is being brought down. So we will take the new value which is given in the adjustment. So here the next liability is with regard to the retiring partner. Now the retiring partner's balance has to be brought down here as his account is not being settled. We have transferred his account to loan account. So this loan is a liability for the continuing partners. So this will appear on the liability side of the balance sheet as his account is not been settled. We write it as Sudeep's loan account from the capital account balance. This is the capital account balance. So we are going to bring it down as the liability since it has not been settled to the partner. So Sudeep's loan account will be 22,000. Now we have to enter the capitals of the continuing partners. The remaining partners are going to continue the business. So we are going to bring down the capital which we derived in the partner's capital account, that is new capital. Pradeep is 26,000 and Sundar is 12,000. So these are the two partners who are going to continue the business. So the total capital will be 38,000. So we have entered all the assets and the liabilities in the new balance sheet. So now the total of the balance sheet will be 76,750 on the asset side, and on the liability side also we will get the same total 76,750. So this is the balance sheet of the continuing partners after retirement of Sudeep. Hope it is clear, students. We will see another sum under 12 markers with a different adjustment. Thank you.